What's up, everybody? It's your boy, Brandon, back with another edition of the Macro Insights podcast. But first, before we get started, a little disclaimer. I am not a financial advisor, and the guest is not giving financial advice. So everything you hear on this podcast is strictly opinion and should not be taken as financial advice. We disclose if we have any holdings discussed in this podcast, and you should not be following us as financial advisors. You should discuss this with professionals before you get involved or invested. And as always, it's not financial advice. So please take this strictly as our opinions and for entertainment purposes only. Now let's get into the show. Hello, and welcome to another edition of the Macro Insights podcast. Thank for everybody listening here on Podcasting 2.0 apps and those have sent me boosts on Fountain. Be sure to leave me a little review or something like that on those boosts or some 5-star reviews wherever you listen to podcasts, and I'll be sure to read them out. And subscribe and like wherever you get podcasts to keep spreading this around. So thank you so much for everybody joining on a weekly basis. I've got a very special guest. You've probably heard him on Spaces around Twitter. Sri, how are you doing today?
Doing well. How are you?
Good. So you're an analyst at Simplify
Asset management.
Yeah,
And
Simplify Asset Management and the host of the Market Champions podcast. So, how are those things going? I know it's a very hectic time right now and, a lot of volatility to say the least. So, how's everything going on your end?
thank you for having me on. So it's really a pleasure to do this. I really enjoy the Twitter Spaces that you guys host every Tuesday evening. So it's fantastic. And then in terms of the markets, so in terms of the podcast and works, it's been pretty fun. It's been sort of a great time to get some of the smarter people who are smarter than I am on, and sort of get to pick their brain about what's going on in markets right now. They obviously, one, have more experience, and two, know a lot more about what's going on, especially as it relates to bear markets. This is sort of the first bear market that a lot of us, including myself, obviously, are seeing, excluding, say, March 2020. That was almost sort of a blip or like a blur. This is sort of more long term in terms of what's happening. And I think, just on that front, I think it's very interesting because, we're starting to see we're starting to see some interesting things happen. We're finally seeing a lot of the so-called growth stocks come down to more reasonable valuations. This is something that we've talked about before, especially during 2020, 2021, talking about how some of these stocks are trading at these absolutely ridiculous valuations. And it's also interesting to finally see stuff like fixed income come back to life. So, that's sort of another interesting aspect that's worth watching. So just overall, it just makes for very interesting markets, considering that over the last decade, interest rates, to an extent, fixed income and FX, they've sort of not really moved that much. So if you look at the 10-year yield, it sort of had a slow grind lower. So, fixed income bolts have made a good amount of money over the last decade. But now, it sort of becomes very interesting because finally, after so long, we're starting to see fixed income yields, especially on the 10-year, 30-year, rise all the way up to close to 4-ish%. They were above 4% not too long back. So it's just very fascinating to watch what's going on in markets these days.
Yeah, for sure. So let's bring it back a little bit though. So tell us a little bit about yourself and your background and kind of how you got to where you're at today.
Sure. So I really got started back when I was 13. I think I was 12 or 13. So, I just picked up a book about finance. I think it was it was a book about picking individual stocks. And then ever since, I've just been hooked. So I've just gone about reading every single book, research paper, article, blog post, so on, and then trying to seek out people who are smarter, more experienced than I am, and try to sort of pick their head about what's going on in markets these days. So I think what's fascinating about, getting started young is sort of, I mean, it's been awesome, having that early start, but also I think it's given me sort of, I started the podcast back in, I think it was grade 10, and So it's been about 4 years since I started that podcast, and sort of using the fact that I was young was sort of nice leverage to get people on. I'm like, I'm young, I want to talk to you about this. I run a podcast, could we make it happen? And so that was pretty cool. And then I really got on Twitter around the start of the pandemic, which is when most people really shifted to using Twitter. And Twitter also had a lot of these super smart hedge fund managers and so on. And these are people and this discourse that you're able to interact with a lot of super smart people, and ask them questions, get their thoughts get different perspectives, and try and figure out where you're wrong, which I think is very important. So I think Twitter really provides an opportunity to do that, especially spaces, etc., like the one you host. I think provides a very similar opportunity. So you can hop on, and there's going to be someone, you could be the one who's bullish on bonds, and there's going to be someone who's bearish on bonds, and you can have that discussion, try and gain the other side, and hopefully in a very civil manner. So that's
Yeah.
sort of what my background is.
Yeah, for sure. So, yeah, I mean, on that note, I mean, you brought up Twitter Spaces and kind of like the discussions. You've got your own podcast, obviously. How do you think that just like that overall discussion and kind of being able to pick a lot of people's minds, whether it's just some anonymous person on Twitter who seems like they have a wealth of knowledge, or maybe some asset managers. What do you think about this? Like, coming up in kind of a place where people are more spreading their knowledge as opposed to like kind of holding their strategies close to the vest.
I think one, it's awesome that there's a lot of people, or there's a lot more people who are willing to share information. So one of the things that does happen on Twitter, and you sort of see this quite often, is if someone is, say, especially say within the crypto and the gold bug community and sort of the bond vigilante community, you sort of see a lot of the civility within the discourse go away. So people get mad, and they start saying all sorts of stuff. And I think that's sort of the bad side of Twitter. But on the good side, I think, one, it's awesome that there's a lot of people who are willing to share their knowledge, and there's many people who specialized in following certain markets. And so some people are very good at following options markets, some people are more focused around FX derivatives, some people are more focused around fixed income and its derivatives, some people do individual stocks, for example, and then some people do commodities, etc. And so I think just within that, just so if you have a question about oil, or you have some view about oil, and someone else is super bullish on oil, while you seem to be more bearish, you're able to have that discourse, and people being generous enough to share their time and knowledge. I think it's very cool, and it's sort of really democratized, and it's sort of it's sort of an overused word at this point, but it really has. It's really improved the access to a lot of these super smart professionals that you can just interact with and ask questions directly. And especially if someone goes on a podcast and they say XYZ is their view, and you sort of disagree with that, you can really reach out to them, text them, or you could reply to one of their tweets and be like, hey, on your recent podcast you said something, and what do you think of this? That sort of disproves that, or that sort of complements that. And usually they're more than happy to reply. So I think that's I just think it's been it's a very cool platform, and the ability to interact on Twitter is awesome.
Yeah, for sure. And you get a lot of access that you normally wouldn't really have access. You just, usually see these people kind of on like CNBC or other things like that. And now, you kind of have maybe a front row seat to go and talk and ask some questions. So it's definitely a great platform. So, but you talked a little bit about, coming up and kind of learning and starting the podcast a few years ago, while you're still, in high school, it seemed. Uh, you know, so, I think that it's probably accelerated a little bit of your knowledge, or at least like helped you kind of feed that curiosity. So it's awesome to see that you're still kind of getting in there and learning a lot. But you know you brought up a little bit earlier about the current market conditions, and it's for you and I, it's both our first kind of like big dip and kind of other than I guess the COVID crash, so to speak, even though it shot back up almost immediately after. So,
Yep.
What kind of things are you looking at when you see this kind of the economy, and how are you kind of analyzing the overall macro environment?
Yep, for sure. So I think one of the things that's worth looking at is housing, and so I think Now, housing is very interesting in many different ways. So, housing is a very strong leading indicator because sort of this housing multiplier exists. And so, housing as a sector sort of requires resources from almost every other sector. So, what in the construction of the house, it requires a lot of these materials, a lot of, drills, machinery, and so on. And then on top of that, it creates a good amount of jobs, not just within construction, but also within also sort of the secondary sectors. Someone has to produce the concrete, someone has to make the cranes, etc. And then on top of that, when people buy those houses and move in, they have to buy additional amounts of furniture. They have to buy sofas, dishwashers, refrigerators, and so on. And so you have to buy these finished goods. And just overall, the housing multiplier is very, very strong. And it's one of this, and I think, just on that front, it's something that really plays a significant role in the economy. So overall, keeping that in mind, I would argue that what we're really seeing on the back of that is we've seen a very, very weak housing market. So I think some of the interesting numbers are really the market, mortgage loan demand, housing starts. So I think yesterday the U Michigan buying conditions for houses came out as part of their consumer sentiment release, and it's just absolutely collapsed. And so if you look at what's happened to it ever since the start of 2022 and 2021, it's just been down the toilet. And just broadly, both buying and selling conditions for houses are down. The expected changes in housing values 1 year down the line is negative, and the last one was negative was 2020, and before that was in the aftermath of the Great Recession. So I think that's very, very fascinating. Um, we're starting to see housing affordability go down. A large part of it is because of the interest rate changes. So we've seen interest rates get hiked up. We've seen mortgage financing. We've seen the financing cost of mortgages also go up, and the interest rate costs that are associated with the mortgages go up. And so, just fascinatingly, the so just on a it's just fascinating because the housing market is super weak, and we've also seen in manufacturing and industrial production slow down, or even go into negative growth territory. And so it's not very strong at all. And one of the frameworks that I found very interesting is Michael Cancho has talked about this hope cycle, where it starts off with housing and then moves into orders, manufacturing, industrial production. Then that eventually affects profits and then affects employment. And just on that basis, we've seen housing, housing has really shit the bed. And so when you think about the shift from housing to orders, we've seen the manufacturing, industrial production, all these new orders, etc., slow down. And so if you look at the various Fed manufacturing surveys, the Dallas Fed, the Empire State Fed, the Philly Fed, the Kansas City Fed, they publish these monthly manufacturing surveys. And if you look at the demand for new orders and new production, that's also come down significantly. Similarly, the expectations for prices paid has also significantly come down. And so, what this tells me is that, one, I just on a production supply chain basis, we're starting to see a lot of these price pressures ease. And that is sort of the one that's promising in terms of inflation slowing down. But two, these orders easing is very interesting because that makes you sort of that, or at least that makes me think about sort of a bearish situation for the economy, because you're starting to see orders slow down, and we've also started to see some amount of profits get hit. So if you look at the most recent earnings cycle, we've started to see negative guidance, negative stress lower in earnings guidance and forward guidance. Some amount of losses have been caused by FX changes, especially for companies that do business internationally. But just on an overall basis, we're starting to see these profit estimates come down. And and the sort of the next domino in that hope cycle is really employment. And as I find what Michael Cancho and his sort of framework to be very fascinating. And I completely agree that the next the next domino to fall, and that we might see very likely towards the end of Q1, early Q2, is employment is also going to start taking a hit. And we're going to start seeing layoffs and so on, and we're going to see some sort of a recession set in, or at least an economic soft spot set in within the next 2 quarters. And so if you think about that, and if you think that inflation is going to slow down, which is what I sincerely think is going to happen, I believe that so my belief is that we're going to start seeing we're going to start seeing price pressures come down. We're going to start seeing bond yields come down as well. So I think, at least from an investment standpoint, bonds look very, very attractive at this point in time.
Yeah, and I agree, and I actually I was really hitting that Cantro, his hope cycle earlier on in this, but I just think it's interesting because I think housing is still kind of teetering in certain areas. So I'd be curious to kind of hear your perspective as somebody who's Canadian, right? I'm in Florida, so I have a little bit of, I guess, a different perspective on the housing market because different areas of the country of the United States that is have been, you know, I guess because of COVID and like openings and what have you, people kind of have flocked to different states like Florida, Texas, Tennessee, and those housing markets. Sure, like I bought a house a couple years ago and it elevated significantly, and it's kind of stagnant at this point, or at least according to
Mhm.
certain estimates.
Right.
But I feel like it's still getting hit pretty hard in certain areas of the country and kind of decreasing rapidly, while areas like Florida are kind of just holding steady, so to speak. So I guess how is your overall view on the housing market in the US, and kind of like how are you looking at it, like analyzing there? Because also the housing market in Canada too is something that's a little wild these days as well.
Absolutely. So, one of the things that I find, or at least I take into account when it comes to looking at the housing market, is there is sort of the structural undersupply of housing throughout a lot of metro areas in the U.S. and, very importantly, in Canada. So, if you ever come to Toronto and then you go take a look at the suburbs of Toronto, like Mississauga, and anyone listening from Toronto, from the Greater Toronto area would agree, is if you look around, you just see a lot of these single family homes, and essentially the way the structure of the housing supply is done is sort of centrally mandated by these various city councils and municipal governments. And so if you look at what a lot of these governments do is they place these zoning laws or these various supply restrictions um, within these municipalities or within these cities. And so essentially they say, within this piece of land or within this zone, you can only construct single family housing. You can only construct the detached homes. You can only construct townhouses. But the thing that they minimize the construction of is are apartments. And so, the higher you construct, if you can build an apartment on that unit of land, you're able to supply significantly more housing. And so, in a place where that could have hosted, say, 5 or 10 single family homes, you could build, say, a 10-story apartment with, say, 5 units on each floor. So you'd have 50 units of housing as opposed to the 10 units of single family housing that would have existed otherwise. And so this is 5 times the amount of housing that would have existed. And, so on that front, the the governments essentially mandate the construction of single family, low supply type of housing, as opposed to the construction of apartments and high-rise buildings that actually said that supply more housing per unit of land. And so if you so one of the interesting facts about the Canadian housing market is, if you, especially in Vancouver, it is easier to get a pope elected to the Catholic Church than it is to get an apartment building approved in Vancouver. And I think that's one. I think that's absolutely nuts. And then two, it's no surprise that a lot of the Canadians, the so-called housing bubble in Canada, is really driven on the supply side more so than on the demand side. And this dynamic holds throughout the year, throughout a lot of metro US. So so a lot of people have single family houses as opposed to apartment buildings. And this is again primarily due to these various zoning laws and supply regulations that exist. And so overall, I think that is that is one of the biggest dynamics that exists within the Canadian, the U.S. housing markets that drive prices so much higher than they really should be. Um, but some part of it is definitely driven by foreign speculation, etc. But the other problem with Canada is the housing affordability. So one of the things that I was reading recently was that in Canada, housing affordability is at a 41-year low. So in 40, so this is the lowest, this is the least affordable housing in the last 41 years. There's this, it's a similar dynamic in the United States as well. So there was a chart that I just published um, the Atlanta Fed just published, and I put this up on my Twitter today, earlier this morning, and it sort of breaks down the changes in affordability. So one, U.S. affordability is also very low, and two, it's been mostly driven by interest rate changes and price changes. But the one interesting dynamic that's very different from the US versus Canada is that in the US housing market, most mortgages are 30-year fixed rate, or 15, 20-year fixed rate. So the mortgages are fixed rate. So if someone was able to lock in 2% interest rate, say sometime in the last couple of years, what they were able to do is essentially they've locked in that interest rate for the rest of their mortgage. But essentially, almost every single mortgage in Canada is floating rate, and essentially the max fixed rate that you're able to take in Canada is 5 years. So most mortgages are almost practically floating rate mortgages. And if you think about that, when the mortgage rates reset, they reset at this super high rate, compared to what people were used to paying. And so therefore this drives interest rate costs higher, and that is another big part of why Canadian housing affordability is so low these days. So I think just broadly, so one, you've got the supply, you've got this big supply issue, and then two, within Canada at least, you have this dynamic of fixed versus floating rate mortgages. And then three, that's some part of that, and due to that, you're starting to see affordability at 40-year lows. So I just think it's absolutely nuts what's going on.
Yeah, for sure. And I don't know if there's any really sign of it slowing down at this point, because it seems like the Federal Reserve said that Jerome Powell's come out and said he's not going to stop until inflation's over.
Right.
There has been kind of a narrative around financial Twitter, FinTwit, as we like to call it, that, there might be a pivot coming up soon. So, what are your views on that? Do you think that the Federal Reserve is going to keep raising interest rates? And yeah, let's kind of get into that.
Sure. So I think what the Fed should do versus what the Fed will do are two very different things. And so, at least at the moment, the Federal Reserve is going to keep hiking, at least at 50, I'd say 50 bips, every meeting, until the inflation number comes down. I think the issue with what the Fed is doing is that interest rates take about 12 to 24 months to actually play into the real economy, and it's starting to. I think this is the quote by Warren Buffett. So Warren Buffett has talked about, and he relates this more to stocks, but it applies here as well. So he's talked about how to have a baby you have to wait 9 months, and you can't have a baby in 1 month by getting 9 women pregnant. And I think it's sort of I think a similar dynamic applies here, because what the Fed is doing is it supposedly is playing catch up with what it was supposed to do. So when you think about what the Fed is doing, it is going after consumption and demand. And I think what the Fed is really doing is implementing a very, very short-term solution to what's going on, to what's going on in the economy, because the primary causes were, one, supply chain disruptions, and two, massive underinvestment in various commodities. And and the real solution to this would be to say, so for example, one of the biggest constraints on gasoline supply, diesel, etc., has been the lack of refining capacity in the United States. So what's interesting is the U.S. has about 130 refineries. So in order to build one refinery, it costs about $5 billion. This is, so from if you look at if you look at the federal government's budget, this is sort of a rounding error. $5 billion is nothing, considering that the government spends over trillion and a half dollars, $2 trillion, whatever. So they could build a significant amount of refining capacity, say 10, 20 refineries, massively boost refining capacity, and this would be sort of a longer term solution to what's going on with oil. However, what's going on is the complete opposite, because one, the Federal Reserve is busy hiking. It's going after consumption. It's going after demand, and we're starting to see some impacts of that. But then on top of that, the federal government seems to be and the federal government seems to be, and we see this more in Europe than in the U.S. is they're happy to hand out money. For example, California was doing it, the UK was doing it, and this was more so to help those low income people afford more groceries. But it's essentially fueling the consumption side even more. So instead of actually solving the real problems, what we're really doing is kicking the can down the road and not really fixing anything that's going on. But back to Fed policy, what I think the Fed is doing is, as much as it's very likely going to kill demand, and probably loan growth is going to slow down, and we're starting to see housing demand slow down, and we talked about how housing spills over into other sectors. What they're essentially doing is, Powell sort of thinks of himself as some sort of Paul Volcker, and I think and I think the typical Volcker story is very misunderstood. But Paul Volcker, at least the conventional story goes, raised interest rates, forced the U.S. into a recession and killed inflation. That's what the usual story about Paul Volcker is. And Powell sort of sees himself as some sort of a heroic Paul Volcker. He comes in with 8% inflation, and then he jacks up rates, starts jacking up at 75 basis points every single meeting, and then when he and then it peaks at wherever, and then once it peaks, what we're really seeing after that is inflation comes down, and there's some sort of a recession, and Powell was brave enough to risk a recession in order to bring down inflation. And this is sort of the story that Powell, at least I believe, has in his mind. And I think this is completely and when I think his interpretation of what went on in the early 1980s was wrong. So I believe that in the 1970s, the biggest driver of inflation was was a demographic boom, and this was led by the baby boomers, minorities, women, etc., entering the workforce, and this was a huge jump in the workforce. So if you look at the labor force growth from or just overall in the 70s, and this was coupled with food shocks, energy shocks, and so on. And you had this massive demographic boom coupled with those shocks, and that led to a double-digit rate of inflation. But when Paul Volcker came in, Volcker was not the inflation did not come down in the early 1980s because because Volcker raised rates. It came down in the early 1980s because Volcker came in, and he was lucky enough to come in at the exact moment that at the exact moment that demographic growth started to slow down. He came at the exact moment when labor force growth started to slow down. And I think if you think about that for a minute, Paul Volcker was not a hero. He was just more so lucky. And what Paul Volcker actually did by raising interest rates so high was that he killed the supply function in the U.S. and essentially forced the U.S. to run a current account deficit, essentially importing the supply deficit that existed as a result of his higher interest rate policies. And so, with that sort of framework in mind, looking at what's going on today, one, we don't have that demographic boom, so I do not think we're seeing a structural shift in inflation. And two, I think the thing that most people forget about inflation is that it's not the price level itself, but it's the rate of change in the price. It is the rate of change in the price that, when we say inflation is transitory or it's going to come down over the next couple of quarters, what we're really saying is that the rate of change of the price level is going to come down. It's not the price level itself. And I think that's where a lot of people miss out or get wrong as it relates to inflation. So just overall, one, going back to Fed policy, and I guess I sort of went off on a tangent, but going back to Fed policy, what really is going on is, one, the Fed is attacking consumption, and two, it's very we're likely going to have a recession due to that, and we're likely going to see inflation come down. But three, none of the structural supply issues are being fixed. So what the Fed is really implementing is a short-term solution, as opposed to something that's more meaningful.
So yeah, I mean, I guess on that note, I mean, it seems like that they're going to just continually raise interest rates, whether it's 50 basis points or what have you, but until inflation is quote unquote slowed down. But like you said, it's kind of kicking the can down the road. So what are it's tough here to make predictions, and that's obviously a very tough question. But on that note, I kind of think personally that you're correct there, where he's kicking the can down the road, and it's destroying the offshore dollar market. So the U.S. dollar and the United States economy is going to do a little bit better than maybe like Europe and some of these others who are a little bit more reliant on the U.S. dollar, obviously as a global reserve currency. But on that note, it is a very global economy. The supply chain issues are still kind of persisting. We've seen production not really come back to those pre-COVID levels, and so I think that we might have like a slight recession, but I think it's going to kind of play out, especially with all these potential geopolitical events that are going on with like Ukraine, Russia, and maybe the Chinese Taiwan potential conflict and what have you. So, do you kind of see it dragging on for a while, or do you kind of see it as another maybe even like COVID bump where once they kind of see something else that they might start going back into QE and printing money again?
So I think one of the risks to what's going on is sort of a potential blow up in the monetary system. And so just overall, if you think about what's going on in terms of monetary economics, the Federal Reserve is heavily focused on, so market, liquidity is one of the key factors in markets, and liquidity is very, very important, of course. And so if we end up seeing another March 2020 type event, it is very likely that I believe the Fed reverses course. And we saw this sort of with the BOE, and when the UK pension fund system was at stake, they immediately shifted. They forgot about inflation, at least for a quick minute, and then they shifted to QE policy. They started buying gilts again, just so that just until the pension system stabilized itself. And what's fascinating, what was fascinating about that UK situation was, one, if the BOE was aware of that situation, my guess is they were probably aware of the systemic risk, and then they just chose to ignore it. And then two, what are that was the UK. What are the risks in the US, and are there some sort of systemic risks within, especially from a positioning standpoint, where people hold these positions, especially derivative positions that may or may not be reported, and they have these positions, and then they have these positions, and then they're sort of in a situation where they're forced to liquidate. And what happens if something like that happens? And then and I think if the U.S. was to see a similar scenario, I think the Federal Reserve would also similarly reverse course and then go ahead and start buying treasuries and reducing rates. Go back to its policies of QE. Just, if we start to see some sort of monetary mayhem, and even if we didn't, and we finally started to see inflation come down, I think that would again be a cause, especially if we enter a recession. That would be a cause for a Fed pivot. But I think one of the probabilities that's interesting is, or the one of the scenarios that's interesting to consider, is that the market sort of prices in Fed hikes. But there's definitely the possibility of the Fed. They've hiked to whatever. I think the Fed funds rate is at 400-ish basis points right now, if I remember correctly, after the last hike. And if I got, I don't know if that number is right, but the point is, they've reached this level, and now there's a strong chance they just stay at that level. They pause. They say, okay, we've hiked so much. This is the fastest rate of hikes that we've ever done. And interest rates actually take a bit of time to play through the economy. Housing has come down. We're starting to see orders, manufacturing production weaken. At least on a sentiment basis. So, for example, consumers are now expecting unemployment to rise in 1 year's time. And so, we're starting to see we're starting to see weaker business conditions, weaker business expectations. We've tightened financial conditions, and markets have moved lower. They could pause here, and then they could sit down and watch for the next few months and see, okay, we've paused. Now, it's time to see what's actually happening. And then the other events that you mentioned, for example, China Taiwan invasion. So one, that would be very, very consequential, and then two, it would be consequential to an extent to the semiconductor supply. But the U.S., from a geopolitical standpoint, has been following this policy of it's starting to move away from getting itself involved in these foreign affairs. So, they were previously involved in places like Kurdistan or Syria. They were involved in Afghanistan, etc. And they finally pulled their troops out. One argument that can be made is that Taiwan has a strategic incentive for the U.S. And the U.S. to defend Taiwan. And I think it's likely that they might say play a proxy war, etc. But this shift in U.S. In the thinking of the U.S. as it relates to foreign policy has been, these are conflicts in these foreign countries. Why should we care about them? Why should we send our American sons and daughters to go fight to go fight a war that completely does not concern us? And the one thing the U.S. has done, for example, is it's gotten TSMC to build a very very advanced semiconductor fab in Arizona. And I think that's very interesting because it's sort of trying to shift away or reduce the strategic importance of Taiwan to the United States. And so if you think about it from that standpoint, what we're really seeing is the U.S. is reducing its dependence on countries like Taiwan. And then the point that you made on the U.S. dollar, I think it's interesting because the U.S. dollar is definitely one of the key variables, especially for a lot of the smaller countries, like a lot of the smaller, say, emerging market countries, etc. And the Fed has been hiking at this tremendous pace. So especially versus currencies like the Japanese yen, the Chinese yuan, etc. To an extent, considering they're exporting economies, they benefit a little bit from currency depreciation. But considering the speed at which the currency is depreciated, especially in places like Japan, businesses and exporters are warning that the depreciation is going to do more harm than good. And in addition to that, especially in places like China, the Chinese lockdowns are very interesting to follow. One of the possibilities is, what if China never reopened? Or what if China reopens and nobody cares? And that was one of the things that I posted a few months ago because I don't remember what city it was, but there was a consumer sentiment survey taken in that city right after the reopening, and it appeared as if consumers simply did not care that the reopening took place. And it's going to take a while to sort of restore consumer and business confidence. And the zero COVID policy is going to be very very difficult to implement on a long run basis. So I say, you simply cannot be locking down your people, every couple of months because of the surge in COVID-19. and and just overall, if you also look at the Chinese, so if you look at the Chinese export, if you look at the Chinese trade balance numbers, for example, you're starting to see that export earnings are not being recycled into higher wages for workers, and therefore it's essentially not going down to the it's not going down to the consumer, and it's not getting translated into consumer spending. And then on top of that, we're starting to see the housing bubble in China start to pop. So we're starting to see developers, especially the super leveraged developers, start to reverse course. They're losing tons of value. They were super indebted, and we're finally starting to see the reversal of that. So that's also been a very very important factor to watch. And on a long term basis, it appears as if Chinese demographics are not in the soundest position. If you looked at Chinese demographics back in, say, the 1970s, they had a lot of kids, and these people came in to the workforce around the 1990s, early 2000s, which was sort of the super boom of China. And then now what we're really seeing is the reversal of that. So we're starting to see additional government control of the economy. We're starting to see the Chinese yuan depreciate massively, and then on top of that, we're starting to see a lot of this regulation, poor demographics, poor consumption, poor household spending, and a huge amount of debt on the private sector. And Michael Pettis has talked a lot about this, and I completely agree. It requires some amount of some amount of the aggregate demand or spending needs to be transferred away from the it needs to be transferred away from the private sector, especially the real estate sector, to household consumption. And I think so. I think overall, there's just a lot of problems. And so considering how weak the Chinese economy is, it's probably not prime time for them to go ahead and invade Taiwan, especially at this moment. Then two, the U.S. is sort of reducing its strategic importance on Taiwan. It also became a net petroleum exporter, and what this essentially does is it actually reduces the U.S. dependence on the Middle East for the supply of oil. I mean, obviously the price of oil, it's still highly dependent on OPEC, but however, for the simple supply of oil, it's not very dependent at all. And so I think just on that basis, it's truly something. It's sort of a very interesting picture to sit down and analyze and try and figure out what's going on.
Yeah, and I think like overall on that, the entire message is essentially like the global economy might be shifting to more of like nationalistic, where each country is going to try to be a little bit more self-sustaining than they are, less reliant on other countries. Because then, if conflict happens, it seems like these other countries can kind of pull the strings, right? And that's where I kind of see it trending. But that kind of leads me to where do you think like there's maybe some good sectors that to look into that could potentially benefit off of all of this? Obviously, potentially some oil and gas companies and some other things that we've heard kind of floating around FinTwit. But what kind of sectors are you looking at to maybe not be as affected as some other sectors here during a potential global recession?
Sure. So just on if we're going into a recession over the next couple of or sort of the next year or so, I find it very difficult to sort of buy equities in this environment. So I think with the uncertainty around interest rate policy, but also on top of that, trying to see um, one with the one and then trying to see where financial conditions head. So if financial conditions continue to become tighter, that's sort of a headwind for equity markets, and not a tailwind. And so with that in mind, I think what's very interesting is going to be if um, I think I find bond very interesting right now. But on a longer term basis, I agree with you. I find a lot of commodity companies interesting. So one shift that I've talked about before has been a potential shift to nuclear energy, and uranium as a source of fuel. So if you look at what's going on in Europe right now, um, Germany has sort of this over dependence, and Germany and a lot of the big Western European countries have this huge dependence on Russia for their natural gas and oil needs, and to an extent also their food supply. And so we're at least what we're really seeing is this prospect of a very cold, hard, dark winter for Europe. But on top of that, on a more general basis, we're seeing that if if you depend on a hostile country for your oil supply, it can be taken away at any second. And you're also, if that hostile neighbor decides to do something stupid or something bad that you as a country fundamentally disagree with, you sort of have to follow along because you are so reliant on that country for your energy needs and for your food needs. And so in order to cause a shift away from this over reliance on Russia for energy needs, I feel that a lot of these countries are going to eventually shift towards nuclear as a potential solution. So nuclear was huge across Germany, France, etc. And they eventually closed down the nuclear plants, and then eventually and shifted towards coal, natural gas. And this has been a hugely based off of a political shift in sentiment. So the big political shift is that uranium is sort of this dangerous metal, and it's very very dangerous. And some part of that is because of the media overhyping stuff like 3 Mile Island, Fukushima, Chernobyl. But as much as the far, far, far left tail, the distribution is terrible. But what is really interesting is that it is actually the safest form of energy, because other than these really bad tail events, and some of them are caused by natural disasters. For example, Fukushima was caused by the tsunami, and so just overall, it's not really, it's not really. It's a very very safe form of energy, just to put it flatly. And I think that's going to be something that we start to see as the world shifts more and more towards green energy, towards sort of the clean energy, pro environment, etc. And I think, for example, Ontario is powered about 60% by nuclear energy, and I think that's very very cool. um, but just on that basis, I think within the United States, we're going to start to see that shift as well. We're going to start to see the advent of small modular reactors, or SMRs, throughout the rest of this decade. And then we're also going to see so I think on that basis, we're going to see uranium and nuclear energy do very well. And then just on that basis, we're also going to likely see stuff like copper do well. So anything that's had really poor capex, but the companies are pretty cheap. They're not too bad. And then and then they have sort of a huge implication in the shift towards green energy. I think overall, those sort of companies are likely to do well. And obviously, you have to look at valuation, make sure you look at the financial statements, make sure make sure the balance sheet is clean, etc. You don't want to buy something that has a terrible balance sheet or that trades at some sort of crazy valuation. We saw a lot of the lithium companies, for example, trade at these ridiculous valuations. Companies like Fuel Cell, FCEL, traded at this ridiculous valuation. And so, just overall, I think it was absolutely maddening to see those sort of companies trade at crazy price to sales numbers, or they had no earnings, they had very few sales, but then they would trade at, say, 50 times or 100 times sales, even though they had almost no sales. And so just thinking about just making sure you're paying a good price for the company. And so overall, that would sort of be my thinking. But overall, in the next couple of years, if we see some sort of a recession, I would just try and avoid equity exposure, or try and hedge out any equity exposure, assuming you don't want to rid your portfolio entirely. And simply, so one of the things that we're doing at Simplify is solving that problem, where we have a lot of these tail risk hedging strategies. I can't talk about them specifically because of compliance, but just generally, we have these various tail risk hedging strategies and these various ways to express equity positions that come combined with again some amount of downside protection, etc. And so I just think overall it's I think it's overall very difficult to figure out what equities to buy for the next couple of years. But over the next decade, I am pretty bullish on some of the various commodity sectors, especially stuff like nuclear.
Yeah, that's awesome stuff. And I totally agree. I think there's going to be a big shift in policies. And I think like the whole ESG narrative might move a little bit towards like nuclear and some of these other more efficient energy systems. And so, yeah, it's definitely an interesting time, and we'll see kind of how these policies around it are affected. But
I think one more thing that I wanted to mention with regard to uranium is that some parts of the ESG narrative are very questionable. So if you take, for example, cobalt production, so a huge amount of, I think over half of all cobalt production is mined in the DRC, and the DRC, has a lot of these human rights, civil rights abuses, etc. So it's very fascinating that cobalt has these large applications within EVs and within the shift to green energy. But however, it's sort of mined in this very non-ESG type place. But with uranium, I think what's fascinating is I know a lot of it is mined in Kazakhstan and Russia, but there's a lot of opportunity for uranium being mined. It's mined in Australia, it's mined in Canada, to an extent in the US, and then and there's a lot of and I think there's a lot of opportunity because there's these various there's this nuclear fuel cycle, and then there's these you can sort of play any specific phase of the nuclear cycle as well. And so I think it's fascinating because there's just these different ways you can play uranium, and that's what makes it super interesting to me.
Yeah, for sure. And I totally agree with you. But, I usually wrap it up with one last question, as it is a very volatile time, and, there's a lot of different things going on. But there are some people that are kind of getting curious and, trying to get started and get their feet wet when it comes to investing. So, what is your advice that you have to people that are kind of, I guess, on the fence and looking to kind of get started in investing in such like a turbulent time like now?
Absolutely. So I think I think the way to proceed would be, one would be to educate and learn everything you can about markets, about individual equities, and then about the overall macro. Read a lot of financial history, try and learn and understand economics. And I think one thing that I would sincerely ask people to avoid would be the Austrian School of Economics. So as I'm not saying you need to become a full-on modern monetary theorist, believe in the deficit myth, so on and so forth. But what I would argue is, you should. I would personally argue. I would personally tell people to avoid Austrian economics, especially if you're getting started, and focus more on understanding the frameworks of thinking within the economy, trying to understand incentives, and then overall read a lot of history. So I think the quote is that history doesn't repeat, but it rhymes, and I think that holds true. I sincerely think that holds true on a long term basis. And so, reading, learning economic, financial history would be one. Educating yourself, listening to podcasts such as yours, and then trying to interact with people. But also, especially within these markets, if you're still learning, obviously, don't bet your house on market going up or down or on bonds or whatever. Play with money that you're able to lose. And it's crazy because as simple, stupid, and as cliched as it sounds, if we see what happened with the recent FTX blow up, for example, or even just a loss of we've seen a lot of money lost in crypto over the last few months. And a lot of that has been lost um, because of people are risking crazy amounts of money. And a lot of people betting their house, betting also betting huge amounts of money on options trades or whatever. And I think I just think that's absolutely ridiculous, trying to act as if the market is some sort of a lotto ticket, and you're just trying your luck. So yeah, that would sort of be my advice. One, learn as much as you can, educate yourself. Then two, manage your risk very wisely. Don't run around. Don't run around. Risking money that was risking more than you can afford to lose.
Sri, thank you so much for your time. I really appreciate it. Why don't you tell people where they can find you and what you got going on?
Absolutely. So you can find my podcast, Market Champions, at you could just search on Market Champions on Spotify, iTunes, or you could just put Market Champions in Google. It just shows up. Other than that, you can find me on Twitter at SRIVATSPRAKASH. So it's sort of a long name, but or you could just search up my you could just search up my name, and you'd find me. And so that's sort of where I talk more about markets, and then you can find more about what we do at Simplify at simplify.us. So that sort of wraps it up about who I am and what I do.
Sri, thank you so much. I really appreciate it. Yeah, we'll
Thanks
have
for
to have
having
you
me
on
on,
in
Brandon.
the future. Yeah,
Absolutely. Sounds
awesome
good.
stuff.